Stocks lower as investors' concerns grow that the first interest rate cut of the year will come later than hoped. We heard from a few Federal Reserve members today, including Cleveland Fed President Loretta Mester. She said she still expects 3 interest rate cuts this year. San Francisco Fed President Mary Daly saying that 3 cuts is reasonable, but not promised. Our first guest this afternoon thinks the Fed does not yet have a green light to start cutting rates. Let's welcome in Lizanne Sonders, Charles Schwab Chief Investment Strategist. Lizanne, always great to see you. Thanks so much for being here.
My pleasure. Thanks for having me.
What changed today? Did anything change today? I mean, because here we have kind of what we have been seeing. In other words, economic data coming in relatively strong, yields moving higher to some degree. Stocks have been pretty resilient this year. Today, we're seeing them roll over a little bit. What's going on?
So I think it may be just an elevated focus on the fact that versus the beginning of the year when the market was way over its skis and expecting the Fed to start cutting in March and up to 7 cuts, that came in line with the Fed, or I should say the dot plot, which is not a policy prescription, and rightly so. Powell continues to try to remind investors of that. But now the market is actually expecting less than 3 cuts, so sort of leapfrogged the expectations set by the Fed's dot plot. And I think that may be coming into the mix. Whisper numbers of Friday being a hotter than expected employment report, which further supports the idea that the Fed should be patient at this point. And even though real rates go up as inflation has come down, it's just not having a deleterious impact on the economy. Another reason why the Fed can stay in pause mode for now.
And Lizanne, we've had any number of strategists recently come on the show and say, listen, you know what? If we get no cuts this year, the market will be just fine. It's about the economy. It's about earnings. Is that narrative now being challenged here?
Well, it depends on the why in terms of what the Fed is doing. It's not as simple as just if we only knew the policy path on the part of the Fed that we would know what the market is going to do. Interestingly, had the market been right at the beginning of the year of a March start and 7 rate cuts, not only did we feel that was the market getting over its skis, I think that would have been a really poor backdrop for the market. That would suggest that we were probably moving into recession type conditions or financial crisis type conditions. I think if the Fed is remaining on hold, say for the rest of this year, if it's not because inflation has accelerated sharply, but maybe it sort of waffles around like it has been, but the economy continues to chug along, that's not a bad backdrop. The worst case scenario, of course, would be if growth rolls over, but inflation continues to accelerate. Call it stagflation, call it reverse Goldilocks. I think that would be something the market would treat poorly.
It sounds like, Lizanne, or maybe I'm implying too much. It sounds like the first scenario you outlined is your base case, that you do think it's more likely that we won't see a reacceleration, or at least not a sharp one, in inflation, and that the economy will kind of chug along?
That's certainly the hope. Now, it's been a little bit troubling, the elevation in inflation, the stickiness. If you look at things like the 3-month annualized change, the 6-month annualized change, be it on PCE, especially at the core level, or core CPI, you have seen that move back up. And the Fed is at least expressing hope that there's seasonals associated with that. We'll start to get a better sense of that, maybe not so much with the PCE report that we just got on Friday, because we already had the data associated with that via CPI and PPI, but the upcoming CPI and PPI reports, because that's past the point you could have some of these seasonal fluctuations. And I think it would be a risk if that reacceleration persists. But base case is that we don't see a significant reacceleration and we continue to see decent economic growth.
And Lizanne, the moves we're seeing in yields right here. So you look at the 10-year, we're back to 4.36. What is driving that, Lizanne? Is that the economic data? Is it because we're dialing back our expectations of when the Fed cuts and how much? Is it our fiscal challenges?
So I think it's all of the above. And, for the period where the 10-year was a little bit more range bound, although trending slightly higher, you didn't see it have a significant negative impact on the market. The fact that it was reflecting stronger growth is part of the reason why we saw that rotation toward more classic cyclical leadership with energy and materials and financials and industrials. I think any significant pickup from here, particularly if there was any sign that we were going to start to head back up to that 5% range, like was the case between July and October, much like we saw in that period, all else equal, I think that would be a significant negative for the equity market, especially if the move up was driven by the term premium or an elevated set of inflation expectations. If it's just stronger growth, obviously less of a negative impact on the market. So it depends on what the drivers of yields are in terms of impact on equities.
And Lizanne, you've pretty consistently said, certainly at least for this year, if not going back further, that you like quality in this market. Yep. I assume that's still the case here.
Absolutely.
Has what is quality changed at all as we've seen kind of a little bit of broadening out and changing in leadership?
Yes, I think bringing sort of value factors into the mix in terms of quality, I think is important given stretched valuations more broadly. But the other factors that have been consistent in our basket of quality factors would be things like strong free cash flow, interest coverage, strength of balance sheet, and then on the growth factor end of things, visibility in terms of earnings and stability in terms of forward earnings. So it's all in the mix, but particularly if you're going down the cap spectrum into small caps, that's where you want to stay up in quality. And that's borne out by what we're seeing in an index like the Russell 2000, where the outperformance within has been the higher quality type names.